All right, folks, Rob Gill here. Thank you so much if you're new to the channel. Continue to follow, please. Today we're going to talk about how to use tax-deferred retirement plans. Now, a tax-deferred retirement plan is not a tax savings, it's a tax postponement that results in substantial lost opportunity costs, limits your investment choices, provides no disability benefits, and guess what? Unless it says Roth in front of it, every dollar on distribution gets taxed at ordinary income. For all you business owners, stay tuned for the rest of this video, even individuals, because we're going to talk about tax strategies. Obviously, you want to get the blessing with your accountant that sits and fits with putting money back into your pocket where it belongs. What are tax-deferred savings? A tax-deferred savings plan is an investment account that allows a taxpayer to postpone paying income taxes on the money invested until withdrawn, generally after retirement. We just talked about that. So some key takeaways. The 401k and traditional IRA are two common types of tax-deferred savings plans. Money saved by the investor is not taxed as income until it's withdrawn, usually after retirement. Since the money saved is deducted from gross income, the investor gets an immediate break or income tax. In a Roth version of either account, the taxes are paid immediately. Okay, let me just say something, folks, because it's important you understand it. Yes, you have a tax postponement in that year, let's say from your 25, 35, 45, 55, 65, but during those 40 years, that money is also compounding fees, lost opportunity costs, and eventually when you take taxes out in retirement, because each and every dollar is taxed at ordinary income. Think of it this way. If you put $20,000 a year away for 30 years, what is that? 20, 40, 60, 80, 100, 20, 40, 60, 80, 100. 20 times 30 years is 600,000. Let's say it's worth $1.2 million, and you start taking money out, 100 grand a year. What you saved in 30 years, you give back in 3 or 4 years upon distribution. So always understand, whenever you're buying something today, what is the tax consequence later on? And if you know that, you can make good decisions based on logic, math, and science, not emotional timidity. Benefits of tax-deferred savings. There are several benefits to the individual. Each year's taxable earned income is reduced by the amount contributed to the account. This lowers the federal taxes owed by the individual for that year. The money is invested in the individual's choice of mutual funds or other types of investments with a balance that grows steadily until retirement. The pre-tax money boosts the amount invested and its potential growth over time. After retiring, the individual draws from the fund for income. Now, a couple of different things you should know here. You want to make sure that you're properly diversifying the portfolio. You want to make sure the fees are as minimal as possible. Tony Robbins said it best in his book, Money Masters of the Game. If you pay 3% in fees versus 2% versus 1%, each percentage point is a difference of 10 years of income in retirement. Just keep that in mind and understand that when it comes to your money, time, freedom, diversification within and amongst asset classes is key to success. And we always talk about this. The right savings plan equals the best results at retirement. What do we mean by that? How do you manage the tax code? Now, you can't manage the tax code, but you want products that you would either take more distributions out of one based on what the tax code is in retirement than the other. For example, if you have a cash value, high dividend paying life insurance plan that's got $1 million in cash value, not a death benefit, but $1 million in cash value, and you got $1 million 401k, and for whatever reason at that age when you're 65, taxes are at the highest it's ever been, take the least amount out of the 401k and more out of the cash value life insurance, and vice versa if taxes go down in any given year. Remember, since the 60s, the government has changed the tax law at least 40 or 50 times. Double check everything I'm saying, but know that at all times there's nothing as constant as change, like waves in the ocean. It just keeps happening every day, all day, twice on Sunday. Okay, folks, here's an example of a client of mine. It's an actual real-life example of clients who started with my accountant first, then worked with Epic. I've given you different names because I'm not here to give you who they are, but here's the story of how it happened. We have Eric and Jessica, hypothetical people, owners of Eric A Company. Both were 62, and when they met me in August of a specific year, they at that point had a tax liability, hear it, a tax liability of $227,000. Now, one of the strategies that we really circled into was a defined benefit pension plan, a 412E3 plan. Contributions invested were into guarantee annuities and life contracts to maximize guaranteed growth and income in the future. So here's what we wanted to do. We wanted to make sure that any dollar we put in was guaranteed, any dollar we put in would give them a write-off, and any dollar we put in would eventually give them a monthly defined benefit that they could bank on for the rest of their life. Now remember, when you're working with any financial educator and or an accountant, someone has to be the quarterback and someone has to be the person that brings it home. In this scenario, the accountant was the quarterback and Epic, I know it's kind of silly, but made the touchdown. In other words, we executed the plan. So this is important. The average defined benefit pension plan one-time installment cost is anywhere between $1,500 and $2,500, and then the average annual administration fee is $3,000 to $5,000. These aren't easy things to set up. When we talk about ecosystem mergers and we do business with other people or other financial institutions, these fees got drastically reduced because of our relationship capital, but within the rules and regulations. So the power of relationship capital, one-time installment fee was $1,250, and since then the annual administrative fee is $1,500. So we were able to give our client a massive haircut when it comes to the money for all the admin costs and the startup costs. Now, the strategy, as I said before, was a defined benefit pension plan, 412(e)(3) plan. The total contribution and fees was $411,948. So let me stop you for a second. They either had to give the government a check for $227 or contribute $411,000 into this pension plan that we created. By contributing that $400, that's money for them later on. The drastic reduction in tax savings was $202,000. So instead of owing $227, after the plan, all they owed was $25,000. Now, assuming the client funds the plan for the 5 years, it will allow hypothetical Eric and Jessica to continue to defer taxes for the next 2 to 5 years. In year 6, the client will receive, and this is the guaranteed pension plan, for life, $9,000 a month by following this strategy. It's important to understand if your right hand is speaking to your left hand, how to be able to kind of do tax strategies that take money out of the government's hand and put it back into the business owner's pocket where it belongs. And in this little micro move that we made, this is exactly what it looked like. For anybody out there that really doesn't understand money, time freedom, and financial planning, I know that may have seemed really confusing. And all I say is take a deep breath and go ahead, click the link below and set up a time to speak to one of my team members. Our process takes 60 days, 6 calls, and we really do a deep dive into your world. So don't be turned off if that was way over your head, because everything is relative no matter who we're speaking with. I want to thank you so much for being part of the channel, watching what we do here in our message. Please hit the subscribe button, continue to like and share all my videos. Looking forward to meeting you in the future.